I want to start today's dive with a ghost story. But it's not a story about a haunted house or, a spooky forest. It's a story about a dinner party.
I have a feeling I know exactly which dinner party this is.
You absolutely do. It's the Thanksgiving ritual. Picture it.
Yeah.
You're there, you've got your turkey, you're trying to avoid talking about politics with your uncle. It's a nice, normal evening. And then the air just, it shifts.
The ambient noise drops.
It does. And from the other end of the table, you hear it. Someone says, "So, how's your crypto doing?"
And just like that, the room divides into two tribes. You have the people rolling their eyes, checking their watches, and then you have the other group whose eyes just lit up with this terrifying manic energy.
Exactly. And depending on what year it is, the dynamic is totally different.
Yeah.
If it was, say, November 2021, your cousin Greg, the one who, usually borrows 20 bucks for gas and still lives in the basement, he's sitting there showing everyone his phone.
Oh, I know Greg.
We all know Greg. He's up 400% on a coin with a picture of a dog wearing a hat. He's talking about retiring at 24. He's using words that sound made up, like yield farming and wagjian and diamond hands.
And you're sitting there with your sensible 401k index fund that did a respectable 7% that year, feeling, what's the word?
Physical pain, honestly.
Yeah.
It's a physical sensation. It's that tightness in your chest. It's the feeling that you are the only person on earth who isn't getting rich effortlessly.
Right.
You're just eating your mashed potatoes, feeling like a complete idiot because you're still working for a living, while Greg is out there surfing the digital wave. You start questioning every single life choice you've ever made.
That feeling has a name, obviously.
Yeah.
FOMO. But I think people really underestimate how biological that reaction actually is. It's not just jealousy. It's a genuine survival alarm going off in your brain.
Oh, we are definitely going to get into the biology of it later. But let's finish the scene. Fast forward 6 months from that dinner. It's the next barbecue, 4th of July. You walk up to Greg. You ask, "Hey, how's the dog coin doing?"
And he looks at you like you just insulted his mother.
Silence. Absolute deafening silence. The headlines on your phone are screaming, "Crypto is dead. Bitcoin crashes. Billions wiped out." Greg isn't retiring. He's picking up extra shifts at the warehouse.
And you.
Yeah.
How are you feeling then?
You feel a mix of relief and maybe a little bit of nasty schadenfreude, if we're being honest, and validation. You tell yourself, okay, see, it was a scam. It was a hallucination. I was smart to stay away. I dodged a bullet.
Until 2 years later.
And the loop restarts. The dog coins come back. The headlines scream, Bitcoin to 100K. And that chest pain, it returns. This is what we are unpacking today. We have a massive stack of research here. Market analysis, behavioral psychology studies, on-chain data reports, and they all point to one thing. This isn't just bad luck. This is not random chaos.
No, it's a pattern. And it's so crucial to frame this correctly right from the start for everyone listening. What you just described, that emotional roller coaster, the envy, the crash, the silence, that isn't a bug in the system. That is the system.
That's a bold statement. You're saying the volatility is actually a feature.
I'm saying it's the engine. Crypto is arguably the most volatile asset class on Earth. But that volatility is a machine. It literally turns human emotion into price action. It moves in these violent waves of euphoria and despair, and most people, like Cousin Greg, they just get washed away by them because they're reacting to the waves instead of understanding the ocean currents underneath.
They're buying because they feel greedy, and they're selling because they feel fear. They're reacting to the symptoms, not the underlying cause.
Precisely. But our mission for this deep dive is to flip that script. If you can understand the mechanics, if you can look under the hood at price discovery in the 4-year cycle, you stop being a victim of the market. You stop drowning, and you can actually start surfing.
I like that image, surfing versus drowning. It implies that the waves are going to come no matter what. It's just about how you handle them. You can't stop the tide, but you can buy a surfboard.
Exactly. We can't stop the waves, but we can learn to read the tide charts. So today we are doing a deep dive into the engine of volatility. We're going to talk about halvings, liquidity shocks, the behavior of whales, and maybe most importantly, the psychology of bubbles.
And we really need to start with the basics because I think a lot of people, even those who own crypto, don't actually understand why the price moves the way it does. I mean, my grandmother understands the stock market. Apple sells iPhones. If they sell a lot of iPhones, they make a profit. They might pay a dividend. The stock goes up.
It's logical.
It's logical. It's linear. It connects to the real economy.
Right. And that is the traditional view of markets, often called the efficient market hypothesis. The idea is that the market is a rational weighing machine. Information is released, earnings reports, sales data, supply chain issues, And the price instantly adjusts to reflect that new reality. If a company earns more, it's worth more. Simple.
But crypto feels, I don't know, messier. It feels less like a weighing machine and more like a voting machine where all the voters are drunk.
That's not a bad analogy, actually. But a better term, one used by the legendary investor George Soros, is reflexivity.
Reflexivity. Okay, let's unpack this. What does that actually mean in this context?
So, in an efficient market, the price reflects the fundamentals. In a reflexive market, the price actually affects the fundamentals, or at least the perception of them. It creates a feedback loop.
A feedback loop. How so?
Think about it. In crypto, when the price goes up, people don't just say, oh, the network must be more secure now. They get excited. The price increase itself generates its own marketing.
Right. Bitcoin at $20,000 is a boring financial asset. Bitcoin at $90,000 is a cultural event. It's on the nightly news. My mom is asking me about it.
Exactly. The price rise generates buzz. That buzz attracts new buyers who see the price rising and they want in. Those new buyers, in turn, drive the price up even further, which creates more buzz. The cause and the effect get all tangled up. The price is driving the narrative, which then drives the price. It literally feeds on itself.
Until gravity intervenes.
Until gravity or reality intervenes. And this is why the moves are so violent in both directions. When that loop breaks, it unwinds just as fast. The price drops, the buzz turns negative, people sell because the price is dropping, which then drives the price down even further. It works in reverse just as powerfully.
So while traditional markets are trying to price in value based on current output, crypto markets are essentially pricing in belief and future potential based on momentum.
Correct. And that brings us perfectly to the first pillar of our deep dive, the mechanics of price discovery.
Okay, let's drill into this, because this is the question that always stumps people when they look at a chart. Let's just say Bitcoin is trading at $90,000. Why? There's no CEO, there's no quarterly earnings call, there's no dividend check coming in the mail. So without any of those anchors, why is it worth $90,000 and not, say, $90?
It really brings us back to the most fundamental definition of what price even is. We tend to think of price as a fixed label. You go to the grocery store, there's a sticker on a can of Coke, it says $1.50. You take it or you leave it. The store sets the price. It's static.
Right. I can't haggle with the cashier at the supermarket.
Exactly. But in a financial market, specifically an order book market, like you see in crypto, price is dynamic. It's not a label. It is simply the exact point in space and time where a buyer and a seller agree to trade right now. It's a constant negotiation happening millions of times a second.
Okay, but what drives that negotiation? Why do they agree on $90,000 today when they might have agreed on $20,000 2 years ago?
It's supply and demand. I know it sounds like economics 101, but in crypto, the properties of supply and demand are incredibly unique, and this is key to understanding everything.
Okay, let's break that down. Supply first.
Sure. In the fiat world, dollars, euros, yen supply is flexible. It's elastic. If the government needs more money to fund a program or stimulate the economy, they just print it. If there's a financial crisis, the central bank steps in and adds liquidity.
As we've certainly seen in recent years, the money printer goes brrr, as they say. Trillions and trillions of dollars entering the system.
Exactly. But in Bitcoin, the supply side is incredibly rigid. It is fixed by mathematics. It's immutable. We know that there are approximately 19.8 million Bitcoin currently in existence. We know the final cap is 21 million, and we will never, ever exceed that. And we know exactly how many new ones are produced every 10 minutes.
And that schedule doesn't change.
It does not change. No matter how much people want it, no matter if the president yells about it, no matter if there is a war or peace, the protocol does not care. It just keeps executing its code.
So the supply is a rock. It's immutable. It's maybe the most stubborn asset in history.
Correct. Which means all the action, all the volatility, has to come from the other side of the equation. The demand side is the variable. It's the water crashing against that rock.
And what drives that water? What makes the demand swell up?
It's driven by a mix of things. There's adoption, by which I mean more people actually using the network. There's utility, the specific problems it solves. There's a huge amount of speculation, of course. But the big driver, especially in these cycles, is narrative. And there's a nuance here that explains the violence the price moves. It's what we call the thin market problem.
Thin, meaning there aren't enough people. Because it feels like millions of people own crypto now. It seems pretty crowded to me.
It's not just the number of people. It's the depth of the available liquidity. Let's compare it to gold. The gold market is just massive, trillions and trillions of dollars. It has literally centuries of accumulation behind it.
Right.
If a billionaire decides to buy $100 million worth of gold, it's like throwing a pebble into the ocean. The price barely ripples. The order book is so deep that there are plenty of sellers at the current price to absorb that huge buy order without moving the market.
The ocean is so vast, but just absorbs the impact.
Exactly. But crypto, despite all the headlines, is still a relatively small asset class compared to global finance. And more importantly, a huge amount of the supply is locked up. People, HODL. They take it off exchanges into cold storage. They lose their keys.
Right, they put it in their hardware wallets and bury it in the backyard, or they just have diamond hands and refuse to sell no matter what the price is, so that Bitcoin isn't actually available for sale on any given day.
Precisely. So the float, the actual amount of Bitcoin sitting on exchanges like Coinbase or Binance, ready to be bought or sold at a moment's notice, is surprisingly low. So if that same billionaire decides to buy $100 million of Bitcoin on a Friday afternoon, it's not a pebble in the ocean, it's a cannonball in a kiddie pool.
Water goes everywhere.
Everywhere. The liquidity just isn't there to absorb the order at the current price. So the buyer has to eat through the order book, paying higher and higher prices to fill their order. This is called slippage. And this is why you see these insane 10 or 20% candles in a single day. The market is frantically trying to find the fair price in what is essentially a very shallow pool of liquidity.
That makes a lot of sense. It explains why a single piece of news or one big buyer can send things flying. But I want to go back to what drives the demand side. You mentioned narrative. It feels like in crypto, the story matters more than the stats.
It does, because it's early stage technology. This is absolutely crucial to get your head around. We aren't valuing crypto on what it does today. If you valued the internet in, say, 1993 based on what it did then, sending slow emails and loading grainy pictures of cats, it was basically worthless.
You couldn't stream movies, you couldn't do your banking. It was a toy for nerds.
It was. We are valuing it on what it might do in 10 years.
Yeah.
It's all about future potential.
It's like valuing Amazon in 1998.
That is the perfect example. If you looked at Amazon's book sales in 1998, their stock price made 0 cents. It was wildly, absurdly overvalued based on its current earnings. Wall Street hated it. They called it Amazon.bomb.
Right.
But the people buying Amazon stock weren't paying for book sales. They were paying for the narrative of the everything store. They were buying the story. They were betting that Jeff Bezos would eventually control global commerce.
So you were buying a probability. You were buying the future execution of a grand vision, not the current balance sheet.
Exactly. And in crypto, price discovery is often just narrative discovery. If the dominant narrative shifts to Bitcoin as digital gold, it's a hedge against inflation, then the price goes up because people buy into that story. If the narrative shifts to Bitcoin uses too much energy and is boiling the oceans, the price goes down. The asset itself didn't change. The code is exactly the same. But the story the market is telling itself about that asset changed completely.
So we have a thin market susceptible to huge splashes driven by these high-stakes competing stories. I mean, that already sounds like a recipe for extreme volatility. But then there's this other layer, the spooky pattern.
The heartbeat.
Right. If you zoom out and look at a Bitcoin chart on a logarithmic scale where the vertical axis handles exponential growth, it doesn't look like random jagged lines. It looks rhythmic. Every 4 years, it's boom bust, boom bust. It's almost eerie how consistent it is.
It is. And unlike the stock market, which follows the vague business cycle of the broader economy, which is messy and unpredictable and depends on central bank policy, this rhythm is engineered. It is literally written into the C++ code by Satoshi Nakamoto. This is the foundation of the 4-year cycle.
And the trigger for this heartbeat is an event called the halving. Now, for anyone new to this, the halving sounds like a title for a horror movie. Coming this summer, the halving. But it's actually just math.
Pure, cold, predictable math. Satoshi faced a big problem when designing Bitcoin. He wanted it to be scarce, like gold. But he couldn't just release all 21 million coins on day one, or a few insiders would just grab them all and centralize the network.
He needed a distribution schedule that was fair and decentralized over a long period of time. He needed to drip feed them into the world, like gold being mined slowly from the earth.
Exactly. So he designed the protocol to be deflationary, or more accurately, disinflationary. He wanted to ensure that the inflation rate, the rate of new supply of Bitcoin entering the market, would decrease over time on a predictable schedule. So when Bitcoin launched in 2009, miners were earning 50 Bitcoin every 10 minutes for producing a block.
which at today's prices would be, I mean, tens of millions of dollars every 10 minutes. That's just insane to think about.
An astronomical amount. But the code has a rule. Every 210,000 blocks, which takes roughly 4 years to mine, that reward gets cut in half.
Hence the halving.
So in 2012, it dropped from 50 to 25 BTC. In 2016, it cut in half again to 12.5. In 2020, down to 6.25. And most recently, in 2024, it dropped to 3.125 Bitcoin every 10 minutes.
So the faucet is getting tightened every 4 years, but why does that create a boom? Why doesn't the price just adjust smoothly to this known information?
Because of the supply shock. Imagine if the global oil industry produced 100 million barrels a day. The entire world economy is calibrated to that specific flow. Everyone is used to buying that oil to run their cars and factories. The price is relatively stable based on that flow.
Right, it's priced in.
It's priced in. Then, literally overnight, a magical switch is flipped and the global production capability drops to 50 million barrels.
Panic, total chaos.
Panic, yes. But fundamentally, what happens to the price? If the demand stays the same, if people still need to drive to work, but the supply is cut in half, the price must skyrocket to find the new equilibrium. That is the fundamental physics of the market.
And this sets off a chain reaction. It's not just that the price goes up a little bit. It's what the price going up does to the psychology of all the participants in the market.
Right. This is where the engine really kicks into gear. Let's trace the steps. Step 1. The halving happens. The inflation rate of new Bitcoin drops by 50%. The miners, who are usually the biggest natural sellers in the market, suddenly have half as much Bitcoin to sell every day.
And we should clarify, miners have to sell.
They have to. Mining is a business. They have massive operating expenses, electricity bills, new hardware, rent on their facilities. They sell the Bitcoin they earn to pay for those real-world costs. So when the reward gets cut in half, the structural selling pressure on the market drops by millions and millions of dollars every single day.
So the weight is taken off the spring, so to speak.
Perfectly put. Step 2. That reduced supply meets steady, ongoing demand. The price starts to tick up. Maybe not immediately, but over the course of a few months. Step 3. That gradual price increase starts to generate news coverage. CNBC starts running segments. Bitcoin breaks 40,000. Bitcoin breaks 50,000.
And that's when Cousin Greg sees the headline and starts getting interested again.
Exactly. Step 4. That news coverage brings in new people. Fresh demand floods into the market. And now you have this violent collision. Skyrocketing new demand is slamming into a supply that was just programmatically cut in half. A bull market is born.
It's clockwork. We've seen it happen 3 times now in a very clear way.
We have. Cycle 1, around the 2012 halving, gave us the 2013 rally. That's when Bitcoin went from about $13 to over $1,000. I mean, think about that multiple.
Incredible.
Cycle 2, around the 2016 halving, gave us the legendary 2017 run. That was the retail mania, the ICO boom. Cycle 3, around the 2020 halving, led to the 2021 mania. That was NFTs, DeFi, stimulus checks fueling the fire.
There's that famous saying, right? History doesn't repeat, but it often rhymes.
It's often attributed to Mark Twain. And it applies perfectly here. It's never identical. The macroeconomic conditions change. In 2020, we had unprecedented COVID money printing. In 2016, we didn't. But the underlying mechanics, that supply shock, remain the consistent heartbeat. Now, I do have to add a caveat here.
The institutional caveat, the BlackRock effect.
Yes. As the market matures, and as we get these financial giants like BlackRock and Fidelity launching massive ETFs, the volatility might start to dampen over time. It takes a lot more money to move a multi-trillion-dollar asset than it does a $10 billion one. A supply shock of 450 coins a day matters a little less when BlackRock is buying 5,000 a day for their ETF, but the physics are still there. It's just moving a much larger object now.
So if we know the heartbeat exists and we know the machine works this way, we can start to map out the plot of the movie. Because having lived through a couple of these, it really does feel like a movie in 3 acts.
It absolutely is. And understanding which act you are currently in is the difference between making a fortune and, losing your shirt.
Okay, let's walk through the script. Act 1, the accumulation phase. Or, as I like to call it, the boring phase.
This usually happens about a year or 2 after the previous cycle's peak. The market has crashed 80%. The tourists have all gone home. Prices are low, they are boring, and they're just chopping sideways for months on end. The general social sentiment here is crypto is dead.
This is the phase where if you mention Bitcoin at a party, people don't ask for tips. They laugh at you. Or worse, they look at you with pity. Oh, you're still doing that? I thought that whole thing scammed out.
Exactly. It's social suicide to be bullish. But if you look at the on-chain data, the actual transactions happening on the blockchain, a completely different reality is playing out. The smart money, the whales, the long-term believers, they are quietly buying. They are accumulating coins from the impatient sellers who just want out at any price.
They're buying when there's blood in the streets. They are buying the fear.
They are. The price grinds up slowly, but every time it drops, they buy more. The public sentiment remains. It's a fake pump. Don't trust it. It's going to crash again.
It's the wall of worry. Markets climb a wall of worry. But then we hit Act 2, the markup phase. This is where the vibe really starts to shift.
Act 2 is usually triggered by breaking a key resistance level. Maybe it's the old all-time high from the last cycle. Suddenly the media wakes up. You see, Bitcoin is back on the screens. Your tech-savvy friends start posting charts on Twitter again.
This is when the skeptics start to sweat. The people who sold at the absolute bottom realize they made a terrible mistake.
Right, so they panic buy back in, which drives the price up even more. This is the hope and optimism phase. You start seeing the price move 5%, 10% in a single week. And usually there's a validation event that comes along with it.
Like the ETF approval, or a major company like Tesla or MicroStrategy adding it to their balance sheet.
Yes. There's a fundamental narrative that supports the price action. It gives people permission to believe again. And the feeling for you, the listener here, is crucial. You feel smart. You tell yourself, I knew it. I knew I should have held. I'm a genius for being in this.
Which leads us, inevitably, to the grand finale, Act 3. The mania. The euphoria. The dangerous part.
This is the vertical phase on the chart. New all-time highs every single day. This is when your Uber driver asks you how to buy Dogecoin. This is when celebrities start launching NFTs or their own tokens. I mean, remember Paris Hilton on Jimmy Fallon talking about her Bored Ape?
I remember that vividly. That was a top signal if I ever saw one. It felt completely surreal.
The internal monologue shifts from I'm smart to if this continues for 3 more months, I can quit my job and buy a private island.
I think everyone who has invested in crypto has done that napkin math at some point. Okay, I have this much. If it goes up 10% a day for the next 90 days, I will be richer than God.
It's intoxicating. It's pure dopamine straight to the vein. And that intoxication is so dangerous because greed completely overrides your normal risk assessment. People start borrowing money to buy more. They take out leverage on exchanges. They remortgage the house.
And here is the paradox.
The great paradox. This moment, the peak of the mania, is maximum financial risk. It is the absolute most dangerous time to be buying. But it feels like maximum financial safety because everyone else is doing it. There's social proof everywhere.
It feels like a sure thing. The crowd is cheering you on.
Until it isn't. The peak occurs when everyone is fully invested. There is literally no cash left on the sidelines to buy. The last greater fool has entered the room, and then a whale sells. A big one.
And the movie genre switches instantly. We go from a heist movie where we're all getting rich to an absolute horror movie, The Anatomy of a Bear Market.
And Act 1 of the bear market is denial. The distribution phase, the price drops, say, 20%.
And what does everyone say? Healthy correction. Buy the dip.
All right, stonks only go up. And for a little while, it might even bounce. But the smart money, the people who are buying in Act 1 and selling at the top of Act 3, they are using those bounces to exit the rest of their positions. They are selling their bags to the retail crowd who are still high on euphoria.
Then comes Act 2, panic, the capitulation.
This is usually triggered by breaking a key support level, combined with some kind of bad news. An exchange gets hacked. There are rumors of a regulatory ban. A major crypto company collapses, like FTX. The price goes into freefall.
And now the people who bought at the top are seriously underwater. They're losing money rapidly.
The psychology shifts to pure terror. I need to get out before this thing goes to zero. It's no longer about getting rich. It's about survival.
And this is where the mechanics of leverage come back to bite everyone. Margin calls. Can you explain that for the listener who hasn't experienced the joy of a liquidation email?
Sure. So many traders use leverage. They might put down $1,000 of their own money to borrow $10,000 worth of Bitcoin. If Bitcoin goes up, they make huge profits. But if Bitcoin drops just 10%, their original $1,000 is gone. The exchange automatically sells their Bitcoin to pay back the loan.
It's forced selling.
Exactly. It's not a choice. A computer algorithm sells it for you. And when thousands of traders are all leveraged like this, that forced selling drives the price down, which then triggers more margin calls for the next group of traders, which drives the price down even further. It's a cascade, a waterfall of liquidations.
Leading to the grim final act, Act 3, anger and depression, the bottom.
The price is now down 70, 80, maybe even 90% from the highs. Everyone is furious. They are calling crypto a scam. They are suing influencers who told them to buy. The Reddit forums go silent. You look at your portfolio and you feel fiscal nausea.
The internal monologue is, I will never financially recover from this.
It's dark. It's a very lonely feeling. I've been there too.
Me too.
It is. But here's the paradox again in reverse. This moment, when everyone hates crypto, when the tourists have fled, when it feels like the end of the world, this is maximum financial opportunity. This is the point of maximum safety because all the sellers are exhausted. There is no one left to sell. But it feels like maximum risk.
And that is the cycle reset point. It's brutal. But understanding this whole cycle is only half the battle. The other half is understanding ourselves. Why do we fall for it every time? Why do we buy the top and sell the bottom, even when we logically know better?
For that, we have to turn to evolutionary biology. Our brains are wired for the African savanna, not for the Nasdaq queue. We are social animals, first and foremost.
This brings us to the two big acronyms of crypto psychology, FOMO and FUD. Let's start with FOMO, fear of missing out. It sounds like a joke, like a meme, but you're saying it's a legitimate survival instinct.
It's a deep, deep survival mechanism. In a prehistoric tribe, status meant survival. It meant access to food, access to mates, safety. If you see your neighbor getting rich effortlessly, getting more resources than you, your ancient brain triggers a loss of status alarm. It screams at you. You are being left behind. Your survival is at risk. Catch up now.
So when I see Cousin Greg buying a jet ski with his dog money, my brain isn't thinking about price-to-earnings ratios or market caps. It's thinking about tribal hierarchy.
Correct. FOMO overrides logic. It bypasses the rational prefrontal cortex and goes straight to the emotional centers, the amygdala. It makes you buy a giant green candle on a chart that is already up 500% because the emotional pain of missing out is greater than the logical fear of losing money.
That is a powerful distinction. The pain of missing out is greater than the fear of loss. So what's the antidote? How do we fight millions of years of evolution?
You can't fight it in the moment. The emotion is too strong. You need a plan before the pump. You need to pre-commit to a strategy. You say to yourself, I will buy when Bitcoin is at $30,000. If it goes to $50,000 without you, you do nothing. You have to sit on your hands.
That requires an insane amount of discipline.
It does. But you have to internalize this. The market always gives second chances. There's always another dip. You have to discipline yourself to not chase the train once it has left the station. Chasing the train is how you get run over.
Then there's the flip side of the coin, FUD. Fear, uncertainty, and doubt.
FUD is information that has been weaponized. In the information age, attention is currency, and fear sells better than anything. But in markets, FUD is often used strategically to drive prices down so that institutions or whales can buy in cheaper.
We see the same headlines over and over. China bans Bitcoin, which has happened, what, 20 times now?
At least. Or Tether is going to collapse and bring down the whole system, or quantum computers are about to break the blockchain, or government regulation is coming to kill it once and for all.
And it works. It spooks people every time.
It works because when prices are already red, when you are already scared and losing money, your brain seeks out this FUD to justify your fear. It's confirmation bias. Your brain wants a reason to sell so it can stop the emotional pain of the loss. Oh, China banned it. Okay, that's why it's dropping. I should sell now to save what's left.
So how do we filter the signal from the noise? How do you know if it's real FUD or just a story?
You have to zoom out to the fundamentals. You have to ask the hard first principle questions. Has the blockchain stopped producing blocks? No. Is the computer power securing the network? The hash rate? Still high and growing? Yes. Is user adoption and development on the network growing? Yes. If the fundamental reality of the network hasn't changed, then the FUD is just noise. It's a narrative designed to shake you out of your position.
There's a chart I love that visualizes all of this. It's called the Wall Street cheat sheet. It maps the cycle of emotions. It goes from optimism to thrill to euphoria at the top, and then down through anxiety, panic, and finally depression at the bottom.
It's a fantastic tool. I tell people all the time, print it out, tape it to your monitor, and ask yourself every single day, where are we on this chart? More importantly, where am I on this chart? If you are feeling euphoria, if you are feeling like a genius, you are near the top. If you are feeling depression, if you feel like a complete idiot, you are probably near the bottom. It helps you objectify your own feelings.
Speaking of objectifying feelings, let's move from psychology to tools. We can't predict the future, but you said we can check the weather. What are the key indicators you look at to get a sense of where we are in the cycle?
There are three simple ones that any listener can check for free. You don't need a Bloomberg terminal for this. The first and most famous is the Fear and Greed Index.
I check this one almost daily. It's at alternative.me, right?
That's the one. It's a simple score from 0 to 100, based on a blend of things like volatility, social media sentiment, and trading volume.
What do the numbers tell us? What's a good or bad score?
So a score from 0 to 25 is extreme fear. The market is absolutely terrified. There's blood in the streets. Historically, this has been a great buy signal. You want to be greedy when others are fearful.
And the other end.
On the flip side, a score from 75 to 100 is extreme greed. The market is euphoric. Everyone thinks they're a genius. Historically, this is a strong sell signal, or at least a don't buy any more signal.
Be fearful when others are greedy. It's the classic Warren Buffett maxim.
Precisely. It's so hard to do in practice, but the meter helps you see the herd mentality objectively. The second tool is the Bitcoin rainbow chart.
This one is fun. It looks like a child drew it, but it's surprisingly effective.
It is a bit of a meme, but it's a powerful visualization. It's basically a logarithmic regression of the price history, which is just fancy math that fits the long-term growth curve of Bitcoin, but it's colored like a rainbow. The bottom bands are blue and green. That's the fire sale or accumulate territory.
So that's the bottoming phase.
Yes. The middle is yellow and orange. That's HODL territory. And the top bands are red and dark red. That's maximum bubble territory.
So if we are in the red band on the rainbow chart and the fear and greed index is at 90,
You should probably be selling some, or at the very least, you should stop buying. When the price hits that red band, it's usually overheating. It implies the price has moved too far, too fast above its long-term fair value trend.
and the third one, this one sounds a bit more technical, the MVRV Z-score.
It sounds complex, but the concept behind it is actually pretty simple and brilliant. It compares two things: the market value, which is just the current price of Bitcoin, and the realized value.
Okay, break down realized value for us.
Realized value is essentially the average price that all holders actually paid for their coins. It looks at the blockchain and calculates the value of every coin based on the price when it last moved from one wallet to another. So it's a great proxy for the cost basis of the entire market.
Okay, so it's basically current price versus what people actually paid.
Yes, and the Z-score just measures how far apart they are. When the Z-score is high, it means the current price is way, way higher than what people paid. Everyone is sitting on massive unrealized profits. And what do people do when they have massive profits?
They sell, they take some chips off the table, they buy yachts.
Right, so a high score is a top signal because the temptation to sell is overwhelming. Conversely, when the Z-score is low or even negative, it means the current price is lower than what the average person paid. The average holder is at a loss.
And people hate taking losses more than they love making gains.
Exactly. Loss aversion kicks in. They stop selling to avoid realizing that loss.
Yeah.
They just hold on, hoping it comes back. Supply on exchanges dries up. That is a powerful bottom signal. When MVRV enters the green zone at the bottom of its chart, it has historically been the absolute best time to accumulate Bitcoin.
Okay, so we have the theory, the psychology, and the tools. Now let's talk actionable strategy. Because knowing all this stuff is great, but executing it when your own money is on the line and emotions are running high is terrifying. How do we play this game without losing our minds?
The first strategy is the most boring, but it is statistically the most effective for the vast majority of people. Dollar cost averaging, DCA.
The set it and forget it method.
Yes, you simply buy a fixed dollar amount, say $100, every week or every month, regardless of the price. You treat it like a subscription bill. You've got your Netflix bill, your Spotify bill, your Bitcoin bill.
Why does this beat trying to time the market? So many people think they can buy the exact bottom and sell the exact top.
Because of the math. When the price is high and euphoric, your $100 buys less Bitcoin. When the price crashes and everyone is terrified, your $100 buys more Bitcoin. You are automatically buying the dip without having to make an emotional decision. You systematically lower your average cost basis over time. Over a full 4-year cycle, DCA beats 90% of active traders because it completely removes emotion from the equation. You don't have to look at the chart.
I love that. It preserves your sanity. What's the next strategy?
Counter trading yourself. This requires some brutal self-awareness. You have to learn to use your own emotions as a contraindicator.
Walk me through that. How does that work in practice?
You have to monitor your own behavior and feelings. When you feel like a genius, when you start looking at mansions on Zillow, when you get the urge to screenshot your portfolio to brag to your friends on Instagram, that is a signal.
A signal to sell.
A powerful signal. to sell at least some. That feeling of euphoria is the market telling you it's overheating. When you want to brag, you should be selling. Conversely, when you feel like an idiot, when you want to delete the app from your phone because looking at the red numbers hurts, when you are ashamed to tell people you own crypto, that is a signal.
A signal to buy.
Exactly. You have to learn to act the opposite of how you feel. It feels completely unnatural. It feels wrong in the moment. But in markets, comfort is expensive and discomfort is profitable.
And finally, the strategy that everyone forgets in a bull market, the one that ultimately ruined Cousin Greg. Taking profits.
This is, without a doubt, the hardest thing to do in all of investing. In a bull market, you always think it will go higher. Bitcoin is at 70,000. It's obviously going to 100K next week. Greed has no natural finish line.
So how do you force yourself to stop? How do you know when to get off the ride?
You need a system. You set your targets before the mania begins, when you are calm and rational. You say, if Bitcoin hits $100,000, I will sell 10% of my stack. If it hits $120,000, I will sell another 20%. You write it down on a piece of paper. You set alerts. When the price hits your target, you execute. You do not think. You do not hesitate. You just sell.
Because if you don't sell...
If you don't sell, you haven't actually made any money. You have just leased the wealth for a while. There's a term for riding a coin from $10,000 up to $60,000. And then riding it all the way back down to 10,000.
A round trip.
Don't round trip your wealth. Until you convert it back to stable coins or your local fiat currency, it's just paper gains. It's just pixels on a screen. You have to ring the cash register at some point.
Leasing the wealth. That is a powerful image. It's not really yours until you close the trade. We've covered a massive amount of ground today. We've looked at the engine of volatility, how the thin market and the halving combine to create these massive economic tsunamis. We've dissected the anatomy of the bull and bear markets, act by act. We've looked at the biology of FOMO and the weaponization of FUD.
And I think the key takeaway for you, the listener, has to be this. Volatility is the price of admission. It's a feature, not a bug. This is a new global asset class, finding its place in the world. And that process of price discovery is messy. It's violent. But it follows a pattern.
The halving creates the rhythm. Greed drives the way up. Fear drives the way down. And leverage just accelerates everything in both directions.
And at the end of the day, the biggest risk in this space isn't the code. Bitcoin itself has never been hacked. The risk is us. The risk is the person looking back at you in the mirror. Your biology wants you to lose money. It wants you to follow the herd right off the cliff. You must fight that biology with data, with discipline, and most importantly, with a plan.
Well said. Now, we've spent a lot of time today talking about the king, about Bitcoin. It drives the cycle. But next time, we need to talk about the rest of the kingdom. Because when Bitcoin starts moving, all the weird stuff really starts to happen.
That's right. Bitcoin is king, but who is the queen? And what about the jesters and the knights? In our next deep dive, we are going to look at altcoins, Ethereum, and tokenomics. Why do all these other thousands of coins exist? What is a utility token? How do you even begin to value something that isn't trying to be money?
I can't wait for that one. That's where things get really wild. The casino, as they call it.
Indeed, it's a whole other level of chaos.
Thank you for joining us on this deep dive. Hopefully the next time you're for Thanksgiving and someone brings up crypto, you won't feel that chest pain. You'll just look at them, smile, and maybe discreetly check your fear and greed index under the table.
Surf the wave, don't drown in it.
Remember, the trend is your friend until the end. We'll see you next time.